Hello and welcome back to All Things Money. I'm your host, David Blaine. Thank you for joining us today. During the first couple segments, we talked about today is the stock market's 5-year anniversary of all-time highs back to 2007. And we talked a little bit about some of the lessons that hopefully we learned. Number one, meaning that diversification works. And number two is if you have some sort of regular savings plan and have the cash to invest, it can be very fruitful to be able to take advantage of severe market declines like we had. But in any event, we want you to look back the past several years and see how you did, see how you reacted. What we're finding is that a lot of people are more and more turning to advisors like my firm to help them navigate these difficult markets. It seems like every year it's something else, and people on their own tend to panic. At my firm, we don't have a magical answer. We don't have some sort of silver bullet or crystal ball, but what we do have is a very disciplined process that keeps investors' portfolios moving forward at a steady rate, and we help apply that discipline that you need to be a good investor. Anyway, so then we were talking a little bit about the concept of, having money to invest and the dollar cost averaging, where you put in a certain set amount every month, $100, $500, $1,000. And of course, if the market is going straight down and will continue to do so, this would be a losing strategy. But historically, if you have a globally diversified portfolio, some stocks, some bonds, real estate, maybe some commodities or gold, things like that, and you're putting money in on a regular basis, and you're rebalancing that portfolio, you can add, 0.5% to 2% of additional return per year. In the last segment, I alluded to another method called value averaging. Now this, especially for younger people or people that are earning a lot of money, this is a really nice way to invest. You don't hear a lot about it in the press because A, it's a little more complicated, and B, probably takes a little bit more flexibility in your budget to be able to do. I mean, let's face it, dollar cost averaging, it's $500 a month going into that portfolio no matter what. Well, value averaging really takes advantage of the ups and downs of the market. And so let's say you have a target of you want your portfolio to grow at 7% per year. And you don't want to make this target too high. If you're not sure what target to pick, give us a call or something. We'll help you figure that out. But let's just say you pick, you want your portfolio to grow at 5% per year. And so at the end of each month, we recommend that people do this monthly. Let's say you start with, $100,000, and your goal is for the portfolio to grow 5% per year. Well, and so you figure out, okay, if to grow at 5% of the year, at the end of this month, it needs to grow 1/12 of 5%. And so at the end of the month, you look at your portfolio and say, well, did it grow, did it grow enough to meet my target? So essentially you take, say you start with $100,000, you want it to grow 5% a year for 20 years, and so you map this out month by month. Month 1, month 2, month 3, here's where my portfolio needs to be. And so what you do is at the end of the month, you look at the actual balance of your portfolio versus your target, and that is how much you save. So for example, let's say, to make my math easy, let's just say you needed the portfolio to go up by 1%. Well, if it didn't go up by 1%, you add enough money to the portfolio to make it go up by 1%, so that at the end of the month you have $101,000, $101,000. If the market goes down by, say, 1%, once again you add enough money, your savings make sure that you're always hitting that target. Now let's say that you have a really good month and the market goes up twice as much as you needed it to. Well, that month you don't put any money into your portfolio. You just set it to the side. Now, the reason this works so well is it is absolutely forcing you even more so than dollar cost averaging. Remember, dollar cost averaging, you're putting the same dollar amount, and so you're taking a little advantage of the highs and lows. With value averaging, if your portfolio goes down, meaning that the value of assets have gone down, it forces you to put in more money into your investment. So you're really buying low. If the next month it goes down, you're forced to put more in. So you're always buying low. And by the contrast, if the market goes up that month and it exceeds your target, well, you don't put any money in that month. The portfolio is meeting your target without the additional savings. And so this method is a way that really forces you to buy low and sell high. And if you have the flexibility in your budget, of course, it's not a problem if the market goes up and you don't have to put as much money in that month, but it can be a problem if the market goes down. You have to have that money. So it's very important that if the market goes up and meets your target, you don't spend that money. You need to set it aside for those months when it goes down. So anyway, that's called value averaging, and it's a great technique for people that are investing and building up their portfolio to really move their portfolio ahead. And your portfolio, by definition, is always going to be growing. Now, for people that are taking money out of the portfolio, dollar cost averaging works in reverse, and so there is some benefit to taking it out. If you have, once again, if you have flexibility in your spending, you can do much better than that. So, for example, if your portfolio goes down and you have the ability to cut back your spending for a little while, that's an even better thing. In the endowment world, I help manage some large pools of money for various institutions, and we use with a 3-year rolling average. So let's say our spending level will be 3% of the 3-year rolling average of the portfolio, so that if the value of the portfolio on a 3-year basis dips down, the amount you're taking out is less, and if it goes up, the amount you're taking out is more. Once again, you're preventing yourself from selling low and buying high, in that case when you're withdrawing. So a couple of good concepts for you to think about. Dollar cost averaging as well as value averaging is a really good technique. Well, that's about all the time we have for today's show. Once again, today marks the 5th anniversary of the stock market high, and we hope you enjoyed the show and that you'll come back again next week. And so for All Things Money, I'm David Blaine.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.